One of the questions I'm most frequently asked, both on this channel and all over social media, is what are the differences between commercial real estate and single-family real estate, particularly when you're looking to get a loan or buy one? Well, ask no more. This is your answer. I'm going to put it here so the next time anyone asks me, you can find it here. But first, like, subscribe, send to your friends, and then we'll jump into it. So let me start off right from the beginning. If you master these skills, you will actually learn to make a whole hell of a lot of money. And while it might sound easy and simple at first, the more you get into it, it's a little bit more complicated than most people think because they have to adjust their thinking as it relates to commercial real estate. Most of us have some experience with single-family real estate, but in order to really define what we're talking about, we need to talk about a very simple and clear definition. When I say single-family real estate, I mean 1 to 4 units, meaning if you buy a property with 1 actual unit in it, or 2 a duplex, or 3 a triplex, or 4 a fourplex, meaning there's 4 doors and 4 living spaces for 4 separate people or families. Those are considered single family for the purposes of lending. You can get traditional single family loans, and you qualify for those loans by your income against the expense of actually having that property. There's a front end ratio and a back end ratio, and you can look those up. There's tons of videos out there for you, but those are really driven off of your cash flow and your ability to repay the loan. And you can choose how much money you want to put down, assuming you have enough personal cash flow to pay that payment. So once you do that in the single family world, they look at your cash flow and they say, okay, you can pay the payment. You've got good credit. You've got all the things they're looking for. Here's your rate. Here you go. Boom, we'll give you an approval. And all is good, assuming your appraisal comes in at the purchase price or above it. And the bank is going to finance you the lower of the purchase price or appraised value to cover their safety. There's not a whole lot that goes into the single family world, but because most of us aim to buy a property or currently own a property, we think that's our barometer for the way the commercial world works. So what inevitably happens is that someone will come to me and say, Chris, I want to buy this piece of commercial real estate. How much do I need to put down? And that is the wrong question in and of itself. The question you should be asking is, what is the cash flow? So much so that cash flow is the determining thing for everything that has to do with commercial real estate, assuming this is not an owner-occupied commercial real estate. Owner-occupied commercial real estate means you plan on occupying it for business purposes. Let's say you have a warehouse and you sell products out of it. Let's say you have a creative studio and you want to run your business out of it. Those are owner-occupied, and that property may have a completely different value to you because you can make money for your business in it. Non-owner occupied commercial real estate is true investment property. You put your money into it, you rent it out to somebody else or something else as far as a corporation goes, and you get cash flow from it. That is why cash flow is important. So Chris, how do I tell if I can afford this property, and how do I tell how much money I've got to put down? Well, you need to get used to 2 very simple documents. Document number 1 is an existing current rent roll. The occupants of that property, who's there? How much are they paying? When does their lease expire? Those are the things you need to know. Document number 2 is you need at least 2 years in the most current year-to-date operating statement or 3 years of operating statements. Those can be found on tax returns depending on the schedule, or they can be found on a separate document from a property management company. Well, why do I need these things? Because what you need to know how much that property is making in cash flow and how much the expenses are. Because you want to figure out how much is left over to pay for your debt service or your mortgage payment. The bank will do that, and they'll come up with a cash flow analysis. There's plenty of different examples out there I can give you, but the best one is to say that for every dollar in expense you have, including your mortgage payment, principal and interest, taxes, insurance, and all the other R&M and other expenses you'll have on that operating expense, there needs to be a $1.15 or more, usually 1.15 DSCR, debt service coverage ratio, for every dollar in expense. So that's 1.15 to 1. $1.15 in income for every dollar in expense, meaning you've got 15 cents of profit built in for every dollar in expense. That is a massively important figure for you to know how to calculate. And most people who get into real estate, commercial real estate, do not understand that. So they'll inadvertently call somebody who's sophisticated and say, hey, what can I qualify for? What's this? And they'll ask you, well, what's your cash flow? And you won't know. So in order to get into commercial real estate, you need those documents. And a lot of people in the single family world aren't used to asking for them, and they don't know how to analyze them. Assuming you get them, here's the way this works. Your property will also be appraised like it is in the single family world. There are typically 3 approaches to value that most banks require. A comparable sale analysis, what did a similarly situated property sell for most recently in the market? Both those that are listed for sale and closed recently. Also, there's an income approach to value. When you reverse engineer the income, how much income that property can possibly make, how much would the value be Inferred, using a cap rate analysis or a capitalization rate analysis for similarly situated investments. And the third is usually a replacement cost new so that the bank can determine what the insurable value should be. The most reliance is placed on the actual income approach to value because that property, as an income producing property to you, the investor, is going to be on how much income can it generate to you. Therefore, the value that is most likely indicative of how much it is on the open market or worth is that income approach to value. A reoccurring theme you'll see when it relates to commercial real estate, non-owner occupied, whether it's in a multifamily apartment complex, a small retail center, a mobile home park, or even a warehouse facility, is it's a reoccurring, resounding fallback to income matters. It matters for how you appraise the property. It matters for how you get a loan. It matters for so much of it. So if you're going into these properties asking how much you have to put down, the right question is how much money does this property make after expenses, and what kind of mortgage will that free cash flow support in order to get a loan for it? In places like California, where the underlying land value is very high versus states like Oklahoma, where the underlying land value is very low, you typically get much lower loan to values in commercial real estate in California than you would for the exact same property in Oklahoma, because that land value adds a tremendous amount to the debt service coverage ratio because the property is so much more expensive to finance. I hope this provides a little bit of insight on how you should be looking at commercial real estate. We've done previous episodes on how to calculate things like debt service coverage ratio, and you can find those here on this channel. But if you have any questions, please feel free to reach out. This is what I do for a living, and I do quite a bit of it. There's no question you can't ask. Just drop them below or shoot me a private message, and I'm happy to share. Financial literacy is what we're about, and I hope this provided you some value. We'll catch you next time.